Hey Josh, like one of the obvious kind of like high level takeaways that I think myself and listeners will come away from everything you just said was the fact that the market over time is obviously more institutions are coming in. It's getting a bit more complex, right? And with that, should we be expecting the market to become more efficient? I mean, I think we talked briefly about Matt mentioned spreads tightening. The 3 month basis coming down from like 45% annualized at the beginning of 2021. Obviously, like Grayscale was trading at a massive premium, and the GBTC trade was huge. I'm sure you guys played a large role in manufacturing some of those trades. But what do you think about over time? Like, should we be expecting the market to just get more efficient as these entities come in and look to take on these more sophisticated type of trades?
Yeah, I think the efficiency of the market is like this sort of like army that's kind of marching across the field, right? And there's like different areas that are closer, right, and more easily accessible to people, and those get sort of arbed out first. And so there's things like the basis trade where all you really need is to have capital, right? You just take dollars, you buy spot, and you sell futures. There's now we've seen just a flood of capital come into the space from institutional market participants that do have the balance sheet to really take advantage of those opportunities. And it's really there's a risk element of it. Like you have to kind of weigh like the risk of taking exposure to a crypto exchange, for instance, or taking exposure to a counterparty like Genesis that operates in crypto. But as more and more people get more comfortable, obviously, the risk premium that comes out of that trade is going to compress. So that is something we see that's becoming much more efficient. Before that, even there was sort of the trade of just pure spot, exchange arbitrage, right? You buy on Coinbase, you sell on Bitstamp. That was like a hugely profitable trade for a lot of systematic trading firms back in 2014 through 2017. Even through
SBF's got that
2018.
famous story about Japan.
Yeah,
Yeah,
exactly. The yen trade or the Korea trade, the kimchi trade.
the kimchi
There's
premium.
the kimchi premium. Yeah, that's been arbed out already. That's even simpler than the basis trade. We're just taking two like for like markets and sort of collapsing them. And then what we're seeing now over time is the frontier is really on kind of on chain activities, right? DeFi. You can kind of see like the shift in how people are extracting value from the market is really less about bid offer and more about kind of more sophisticated financial engineering, sort of engineering exit liquidity in some way, or sort of converting sort of time value and liquidity preference into sort of yield, right? So like you have these lockups on tokens, you throw them into single-sided staking, and in exchange you get some yield, but you're locking up your tokens for some long period of time. And there's maybe ancillary benefits to that. There's maybe you get vote you're it's like a vote escrow situation where you have some governance rights, but all of it is sort of pricing out and unbundling like different aspects of token governance and putting a price on it. And that's kind of how people are extracting value in the market now. And that's going to become more efficient over time too. But right now, there's a lot of uncertainty of how that stuff is priced.
Yeah, I echo everything Josh said too. And like, I mean, you could also see this playing out in live time. Like we've both been here now, or at least been trading the markets for, 3 to 5 years. And I remember when I first joined in 2017, like spreads on spot, right? Like people would pay 100 bips on an institutional BTC trade. Like we were clipping 1% and on Bitcoin, we were probably clipping 2%, or not and like 1% notional, 2% on ETH trades. So obviously like spot was the first thing to get, to get kind of grounded in reality and kind of get tied closer to like what you see in traditional markets, even though we still have a long way to go. And then lending rates, right? Those kind of got squashed into what Josh was saying. And then obviously like DeFi now is kind of the next thing. We'll kind of see how long it takes basically for like those with capital to get to a point of sophistication where they're comfortable enough basically arbing that out as well. But then it's like, who knows what the next frontier might be. So I think like, there's going to be pockets of innovation that continue to spur in crypto that then drive an efficiency and arbitrage. And my guess is that like the speed at which those arb opportunities get crushed is going to just happen faster and faster and faster until the market becomes ultra efficient. So when you think about like a trading business, like it doesn't sound great, but at the same time, the pie gets a lot bigger, right? Like as there's more market participants and as there's more true buy side coming in at some point, right? There's just going to be a bigger pie to kind of go around. And then every big trading firm is going to kind of have their own unique edge in like, really like moat around what they do and kind of core value add. But right now I'd say we're kind of somewhere like in the 5th, 6th inning of like that efficiency curve. We're not quite to the point where you see traditional markets, but obviously we're nowhere near where we started, back in 2016, 2017.